Hey guys, what's going on? Mike Wagner checking in with a whole bunch of math this morning. I thought I would share this because we've kind of come full circle on our Bronson self-storage facility. Quick reminder for those of you following along at home, we bought this property in April of 2018. Purchase price was $465,000, and uh, I wanted a little bit of working capital. We had about $15,000 in repairs to do, and then I wanted 20 grand in the bank as kind of cushion in case there were extra repairs, in case we were negative cash flow in the beginning. Just some, we want to make sure that we borrow all the money we need right up front. So we raised $500,000 to purchase this property. It's about 23,000 and change rentable square feet. So price was certainly right. I think purchase price was 19 bucks a square foot. When you add in the working capital and improvements, we were just over 20, 21, somewhere in there. But bottom line is, I structured this deal in almost a no money down fashion. I put $5,000 of my own money in, and then I raised the remaining $495,000. And when people ask me, well, how'd you do that? One is I certainly relied on my track record of having turned properties around like this before. But one of the big objections I get are, Mike, who are your investors? They must be crazy. You put in $5,000 and you get to own 76.5% of the company. And my two investors, my two equity investors, put in 95,000 and 25,000 respectively, and they received a 19% and a 4.5% equity stake. So the objection is, well, Mike, they put in way more money than you, but why on earth would they do that? Because you didn't put in nearly as much money and you're getting the lion's share of ownership. And, when you're doing a comparison, who gets what, I can kind of see that. But the truth is, investors are concerned about making the most money they can in what they deem to be the safest way possible. And so I always encourage folks not to look at it from a scarcity mindset where, for me to win, you have to lose, or for you to win, I have to lose. We can all win. And I want to show you how that played out here for my investors. Now, you may be asking, where'd the rest of the money come from? I also borrowed $375,000 from debt investors. So people that gave me their money in exchange for a fixed interest rate. It was 12%. We only needed that money for about 5 or 6 months, and so they made 5 or 6% on their money. There were four or five of them that combined to make the $375,000 loan to the company. But what I want to talk about today is the equity investors, because again, I want to address that. Hey, Mike, why on earth would anybody do that question? And so here's what we did. Right up here on the screen, you can see I have the equity calculations. And this is basically a profit and loss for the last 12 months of the property. And so we've got our income up top of $151,000. And then all right here are our expenses. What we're trying to get to is a net operating income, because that's how we're going to determine the value of the property and the equity that we've created over the last, whatever it's been, 16, 17 months. So you can see here there's a net ordinary income, is what QuickBooks calls it, of $63,000. So that's 151 minus all these expenses gets us down to 63,000. I know it's a little blurry, but hopefully you can see that. What we had to do is add back the interest expense, because that expense is not one that goes into the NOI calculation. So we get our adjusted and accurate NOI of 101,000. Now, my agreement with these investors was that we would value the property at an 8.5 multiple of the adjusted NOI. So when we do that math, we get a value of $860,000. Now, you can see here there's a mortgage. What happened is 5 or 6 months in, I provided a mortgage to the company, and it was about $390,000 that we needed to buy out those debt investors that I had mentioned. So the $375,000 that we borrowed, I had the interest had accrued and got up to $390,000. Now I had just come into a big windfall of cash from the sale of another property. So rather than have our company, this facility, continue to pay those investors 12%, my equity partners were more than happy to allow me to step into that role as the banker, because I lent the money to the company at a very reasonable 5.5%, right? The next two lines, investor principal one, this is the money that they paid in. It says 90,000 and 25,000. I do need to correct that. That should say 95,000 and 25,000. So 358 is probably not accurate unless I just wrote it down wrong but did the math proper. I'd have to double check, but you'll get the concept either way. Long story short, $360 roughly $1,000 in equity created. Now, what we do is then take each investor individually. This sheet is, and the next sheet will be identical to this except with the second investor's 4.5% stake calculated. This is just the last couple months cash flow for the property, which they are also entitled to. This investor was entitled to 19% of the cash flow, and I had already paid them in previous distributions from start till the end of June of this year. So I just needed to get caught up if I was going to buy them out fully. So July and August of this year, we did the income and expenses, and then we get our net income or our cash flow, and that was $3,865. So this investor got his 95 grand back. You can see I wrote it properly there. $68,000 in equity, which is 19% of the number from that last page I showed you, and then this bit of cash flow that I still owed. And we did all the math, add that up, and he's getting just short of $167,000 back to pay him off. Now he's already received $15,625 in distributions of cash flow between when we bought it and this past June. So to figure out why on earth the investor would do this, we calculate a return on investment. So if you add what I'm going to pay him off to buy him out right here with his prior distributions, you have a total of $182,000. Now we want to subtract out the 95 that he put in. So he turned $95,000 into $182,000 in 17 months. Now that's a 92% return on investment, but of course it was more than a year. So what we do is we divide by 1.41, which is 17 months over 12 months, just to get it's 1.41 years that he was involved, and he got a 65% return on investment. Not too shabby, right? That, I think, is a pretty clear reason why he would do this investment, right? He had faith and trust in my ability to make this property profitable for all of us, and he wasn't worried about the fact that I also did really, really well with my, comparatively speaking, small investment of money into the property. Now I invested a lot of time and effort as well, and so clearly they understood that. If we switch over here to this last page, this is investor number 2. I'll go very quickly because it's identical to the last sheet. It's just he put in 25 grand, so his equity stake was worth 16. This is the cash flow for the last 2 months, and we add this all up, plus his prior distributions. And again, you can see the math is very similar. His return on investment was a little more modest at 58.5%. The reason being, investor 1, as his label may indicate, was the first one in, and he was the one who really allowed me to do the deal. This second investor, truthfully, I didn't need his money as bad as I needed the first guy's money. And so though he put in 5% of the purchase price, he got a 4.5% equity stake. Now still, he did very, very well, and trust me when I tell you he's not complaining. The last sheet I wanted to show you here, these are the checks that I'm sending out. This last guy, the 4.5% equity here, is receiving his check for $42,000, and this 19% equity is receiving his check for just short of $167,000. Our investors, the debt investors that I mentioned, made their 5 or 6% over the 5 or 6 months, so they got a 12% return on investment. And then I now am in a position where, since I've bought these two gentlemen out and we've paid off the investors, I now own this property 100% free and clear, 18 months after having used this relatively straightforward, but there's some sophistication to this type of structure. I call it a hybrid model of funding. There's equity investors, and then debt investors. That's where the hybrid comes in. But 18 months later, I own this free and clear, having only put in, my original $5,000 in infusion of capital, and then that 390. So I did put $395,000 of cash into this project. Now I own it outright, and it's worth somewhere in the neighborhood of 1.4, 1.5 million, depending on the math. So take that for what it's worth. Hopefully you find that to be informative and maybe enlightening a little bit, hopefully a bit inspiring for the kind of things that you can do in this storage game. And happy to answer any questions, poke comments below, do whatever you want to do. And I will be sure to get back to you real quick. All right, guys, be good.